Hi, and welcome to the Trading Bell. Now, the Finance Bill has been tabled in Parliament, that is the Finance Bill 2025, and is currently under review by the Department Committee on Finance and National Planning. For us here, at these initial stages, we want to have a conversation and dissect what are the contents inside it, and what does it mean for you as well in the investment side of things and also in the business landscape. I'm joined by Fred Kimotho, Associate Director, Deloitte East Africa, and also the Tax Policy Lead right there at Deloitte. Welcome to the show. I just want to start by asking you, I'm sure you have already looked through, or you're already even looking through, and probably also planning to go to Parliament and give your submissions on this particular bill. First of all, when you look at it, just at an overview level before you get to the details, what is your key takeout?
Looking where we are coming from, the Finance Bill of 2024 and now the Finance Bill of 2025, I would probably not even give a very fair comparison between the two, in the sense that if you remember the Finance Bill of 2024, it was actually more on leasing additional revenue. The amount it was targeted to leasing was around 345 billion Kenya shillings. Which is quite an amount. Yeah, it's quite ambitious. So, of course, you had new taxes, new frontiers being touched. So, when you look at the Finance Bill of 2025, which is the topic of the day, you actually realize, a scenario where we are not going into introducing new taxes. It's actually more of what I would call rationalization of tax expenditure. So we are seeing a bit of exemptions being removed, a bit of incentives also being removed, a bit of cleanups here and there. You remember we had a Tax Laws Amendment Act of 2024 that became effective on 27th of December of 2024. There were a few things there that did happen that this bill also seeks to probably overturn or maybe correct. So over and above, I look at it as one that is probably just responding also to what the outcry that was raised by the citizenry in terms of the government not going so much on new taxes. But there's quite a bit of things that will also maybe touch on the common man.
Let's get to some of the components. I was trying to also pick up a few things here and there from the bill. And I want to start from the income tax and on the employee and corporate side of things. Let's start with what we have been calling, I think there's been a lot of talk on the PDM threshold increases. And for me, the question is, what is the real impact of this new PDM threshold on employees and employers from a compliance and administrative burden perspective? I'm sure you have chewed on that.
From an employment taxes perspective, actually for the first time, looking at the previous 2 years, employees have actually probably been the most impacted, because you remember there was introduction of that 2.5%, 35% of the tax bands, quite a bit of things, including housing levy and the levies that you have seen, including the SHIV. Under the Tax Laws Amendment Act, we also saw the employee being more or less given back a bit. You remember there are a few changes in there. And I think we continue to see that even under the Finance Bill of 2025, only that for employees now, it appears like the changes are very, very few. Actually, the one that you have mentioned is the most monumental one, where the bill is proposing to increase the per diem threshold from the current 2,000 Kenya shillings to 10,000 Kenya shillings. Basically, what that means is that if you're an employee and you're working out of your area, so you are then entitled to some per diem. So currently, if you're paid 2,000, you need not to account for tax on that. So it's basically tax-free. I would then say that maybe taking it from 2,000 to 10,000 is just probably, aligning it with the economic realities, because you can be sure that even accommodation, that the cost of accommodation, of course, has gone up. There has been inflation, those kind of factors. The only question is whether probably it has been informed by some sort of research. But also there has been the question of also harmonizing what our colleagues in the public sector are getting and what the people in the private sector do get, because the public sector more or less relies on what we call the SRC guidelines, which the threshold are a bit high on that side. So it's a good one to have. I hope the employees will feel like they have been given back something.
Let's move on now to another part. And this is the pension withdrawals and tax exemption. And I put out this question so that at least we can understand, because there's a lot of pensioners who really want to know what is in it for them. Does increasing the tax-free withdrawal from pension schemes offer meaningful relief to retirees, especially in light of inflation? Because there has been this particular introduction of increasing the tax-free withdrawals for pensioners.
It actually does. And I think the general policy framework that the government has put out, maybe through what we call a medium-term revenue strategy, is where we move to a model that we call exempt.
Yeah.
I'll explain what that means.
Please.
So it means that when you are contributing, you're exempt from tax. When you invest, that income is also exempt from tax. And when you withdraw, it is also exempt from tax. So you've seen a bit of changes in the last couple of bills that you have probably seen, just trying to rubber stamp that so that then you can encourage the culture of saving. So the thresholds being increased is a fantastic move, and we believe maybe you'll see some bit of traction as far as that one is concerned. I must say that for the finance bill of 2025, the main thing that has happened is the gratuity, because gratuity had been left out. Gratuity now has been included as part of what we have under the first schedule of the Income Tax Act, meaning that also the withdrawals then would be exempt, which is obviously a welcome move.
I just want to put some color into it, just to help our viewers as well understand what was happening previously when you wanted to withdraw your pensions, and what is the government really trying to do now?
If you contributed anything below 20,000 before December last year, then that was exempt from tax. But then should you contribute higher than that? Because the 20,000 threshold had been with us, I think, for many years, I think over a decade. So then the question was, are we aligning with the realities in terms of what is happening? So fast forward, what then happened is that threshold was reviewed from 20,000 Kenya shillings to 30,000, which is 360,000 per year. So basically, it's just trying to review the thresholds from all the facets, be it contributions and withdrawals as well. Now, for example, for the 65 years old now, when you're doing pension, then it would not be subject to any form of tax, which is a good move. At the time it had been deleted, whether inadvertently or knowingly, which obviously is not very good for our senior citizens. Yeah.
Let me move on now to the capital gains tax, especially on NSE listed shares. I'm sure we are at the NSE. This is subject to interest as well. So what are the broader implications of removing this capital gains tax exemption on listed shares for capital markets growth and investor sentiment?
It has actually not been removed as per se. Actually, the change that has happened at the finance bill is a positive one, you ask me, because we used to have the exemption of gains that you derive on securities that are traded within the stock exchange that is licensed by the Capital Markets Authority. But that exemption had been provided under the third schedule of the Income Tax Act. So basically, it had been provided where it more or less would appear that exemption was only applicable for companies. What has happened under the Finance Bill of 2025? That provision has been deleted and moved back to the first schedule, to the Income Tax Act. What basically means is that the exemption continues for companies, but most importantly, we now have it very clear that even for individuals, when they trade securities, the gain that they make is actually exempt from tax. So it's a positive move, I must say.
All right. I want to move on now to this different section of the business and company taxation, which I know is also of very much interest to the people who are here. And there's this limiting tax loss deductions to 5 years. And I thought that's a welcome move, but I would want to hear your sentiments. So how does this change impact startups, businesses that experience long-term capital investment before profitability?
One of the discussions we have had as a country, for many years, is how predictable and how stable our tax policies. So if you look at that provision alone, I think I have seen it evolve from where the tax losses used to expire within 5 years, the current year and for succeeding year. It then went to 9 years, 1 year, the current year, 9 succeeding years. It was then removed so that then the losses, you carry them forward in perpetuity. Now we seem to have gone back to a limit of 5 years. So it's more or less paint a picture of a policy that is not very, very stable, which then would negatively impact on the businesses. So maybe then to answer your question, it is certainly will have major impacts on capital-intensive businesses because now they are not able to carry forward the losses, even when the losses have been genuinely incurred.
still on the business and company taxations, we have this advanced pricing agreements, APA. I'm not sure what they are aiming at with this. What are you seeing with it?
What it basically provides for is that now as a taxpayer and you're dealing with multinationals in what you call, you have related party transactions, you can now approach the revenue authority in advance and mutually sit down and agree that this is how I'll price my transaction. So what it basically does is to give you a lot of certainty, even as you do your business. Of course, it is going to be entered into for a maximum period of 5 years. So then you're able to agree with the commissioner in advance that this is how I'll price my transactions. As a result, it preempts a lot of disputes. So currently, what is happening is that you want to have a related party transaction, so you just do, maybe you engage a consultant, or you just do your benchmarking, then you just agree that there's a price I'll charge my related party. So the revenue authority comes to you 5 years down the line, and they tell you, you know what? You have been charging very little. You needed to have charged more on this particular transaction. And we have assessments that are going into billions as a result. So the advanced pricing agreements now is certainly a very positive move. It actually aligns with the global best practice.
Fair enough. This is 100% wear and tear deduction. That should be good news.
What happened on that specific one? And that's why I told you, remember in my preamble, the bill appears to focus more on the expenditure side. So actually what has happened for that one is that they seek to delete the 100% reduction that is provided for under the law. So currently, if you, for example, invest more than 250 million in form of capital expenditure, and you're outside the city of Nairobi and Kisumu, or Mombasa, sorry, it's Mombasa, then you end up getting 100% deduction on the capital expenditure that you have. The same case applies to investments within a special economic zone.